to you. Today is Tuesday, March 17th of this year, 2026, and today is Science Patrick Day. If you are into festivities, compared to all the things that are going into the world, it's good to have a good party, if you may. Right, my name is Francisco Gaffney, and this is my daily streaming all about governance, risk, compliance, and advisory boards. Now, yesterday, I opened the week with scale, how scale works. And today I want to talk about the things board often confuse with scale, which is predictability. And why I'm saying this, because growth is not the same as predictability, and sometimes is confused or is used interchangeable, if you may. You can grow and still get weaker. You can grow and still become harder to finance. You can grow and still train the organization to depend on late interventions, heroic decisions, and optimistic assumptions. So that is the risk today. So are your organization predictable? And here's one thing that I want to bring to the focus today, or the light is, I mentioned, a good friend of mine also mentioned this in a different context, which is leadership focus. So what is going on actually in terms of innovations, uh, how to handle ambiguity or uncertainties about what is the market going, where the economic is going, where the technology is going. So he called it that leadership fog. In terms of growth and predictability, I call it capital fog, because how many times your organization went to the bank, to the financier, to the investors, to the stockholders, and had a no as an answer in a long scheme of things, at the end boiled it down to no, sorry, no more money for you. Why? Because the capital is not clear, and I mentioned capital as all these institutions and people that actually can provide funding to the organization. The capital is not clear what is going on and what is happening. It's not predictable. So if it is the fog that makes the board think the plan is working because the top line is moving, right? So we say, why will you say no? You say, well, the top line is moving. So you have cash, margin quality, asset intensity, and funding resilience are getting worse underneath. And say, why? Because this is something like is happening underneath. And when you say the top line is working fine, but what is going on the bottom line? So this is exactly why the second section of the advisory board operating system matters. And let me show you what we talk about here on the screen. So yesterday we spoke about when you're looking for a commercial acceleration, so how to scale. And today we are looking into the second portion, which is your partnerships, your revenues, and your assets in terms of predictability. So how you grow and you use your capital for your company, right? So as a board advisor, I use this part of the model, the right section, to help the boards first and the executive teams and the leadership to see where growth is reliable, where it is fragile, and where an international advisory board looking from the outside in your organization can be assembled around the real bottlenecks in a fraction of the time. And not trying to recruit one perfect executive, a big consulting overhead. So this avoids a few things. One is the talent lock. So you are not locked with one talent if you have a big name recruit, and the capability to refresh every 6 months as the agenda changes. So as an international advisory board, for example, if you look into, we have, for example, in another things that I'm doing, we are working with a company with a 12 months plan towards pitching for funding, right? So we start to understand actually the last year they tried to do rounds of investments, but they couldn't. But the reason was not the product, was not the footprint in the market, was not the capacity or the technical engineer expertise. All those things were very good, very fine, and with evidence. But underneath, the organization was not prepared for more capital, right? So that's a big problem. So on the top line, you will say, look at this company, it's amazing. But when you start to dig into who is doing what, when, how, and dependabilities, then you have a challenge. So let's see three problems with these challenges. Number one is and I'm going to use the UK frameworks, guidelines, and compliance regulators, because are very clear. You can check that online by yourself or with your team. And if you are in a different country and different regulatory environment, these are very good guidelines, statistics, and frameworks that you can copy and paste, and then you adapt to your own organization and geography. Now, problem number one, the UK business investment failed by 2% in Q4 2025. I don't know if you were aware of that. That matters because when the investment backdrop softens, weak capital allocation gets punished earlier, not later. What I mean is what this example of this company. So when the back end of the organization is not hard enough as the front end. And when I say back end, is your systems, capabilities, revenues, etc., are not hard enough as your products or services, then the capital start to be hesitant to become part of your organization, meaning you're not fundable, or you are fundable, by the way, but actually they are, as they call it, not investable, or actually we have concerns here. Probably we need to come back in 3 months' time to see how you're progressing. Have you heard that thing before? Problem number two, the British Business Bank says risk aversion at 77% and delivering at 75%, where the main motive behind is low investment, meaning that actually they are working at 75% capacity of the loan capacity. So why that is happening? That tells you the problem is not always a lack of ambition. Often is a lack of confidence in the quality of the return, right? So they say, back to this company, very, very skilled, very good, solid product line, but behind the product that they offer into the market, the organization itself, the bank is saying, we like it, but we don't know if you're going to be able to keep this commitment in the next 5 years, 3 years, or whatever is the term that you're negotiating, right? And problem number three is in January this year, there were 1,744 company insolvencies in England, and administrations were 14% higher than January 25, a year later. And we're not talking about, oh, this is historical statistic. This is happening like literally a month or 2 months ago. And this is another thing, 41% is higher than December 2025, this current month. So far, by the way, sorry, my apologies, in January. Well, what is going on? That is what happens when capital discipline arrives too late. So people are going into the last minute looking for round of funding, and companies become insolvent because they cannot raise as fast as they should. The companies are getting tighter, and the frustrations start to create more problems than actually solutions. So let me put it in these ways. In other words, imagine an unpredictable growth model is like filling a bathtub with the plug half out. So activities is in, so it's a lot of water coming into the bathtub, but at the same time you have a leak, and the value goes away while you're trying to fill in that leak. So when you're going to growth, when pretty much is all the time compensating, so more things are coming in, but the same amount is going out. The problem starts with the things are going out are bigger or faster than the things are coming in. And here's the trap. Boards look at the pipeline, the management looks at the bookings, the commercial teams look at demand, but the question that decides enterprise value is much, much simpler. And I'm going to say, which is a question really, is how much of that demand converts into cash? And this conversion with enough regularity and the margin quality and the resilience to support investment, governance, and confidence, right? So the key word is here, how much of that demand that you already have converts into cash? If the answer is vague, growth can start to feel like a money trap, right? So you need more working capital, you need more executive time, you need more exceptions, you need more rescuing. And rescuing, it doesn't mean actually a bailout. It means actually you go to your investors, your stockholders, to the bank relationships, and they say no. All right, but unfortunately, that's the bottom line. They say, I'm sorry, not this quarter, perhaps next quarter. Bring the numbers for next quarter to see how you're progressing. Have you heard that before? It's very painful. Anyway, as an advisor, what I would propose to consider is the following. And number one, separate revenue by behavior. And what you were talking about is not your product lines. Um, Put every revenue stream into one of these three groups. This is recurrent, this is repeatable, and this is volatile, right? Until the board sees that split clear. And when I say board, I say your executive team, you as a founder that have everything in your head, and you need to make sure that everything's working. Just do the split. What is a recurrent revenue? What is repeatable? What is volatile? And if you don't have a clear answer here, you're governing optimism rather than predictability, because you have to have very clear numbers. It's not just about the per line product line, it's about the cadence of the whole revenues that are coming into your company. Suggestion number two, put capital gates around expansion. What that means, that the Bank of England's credit condition survey is a reminder that lending condition and pricing do not sit still. So expansion should clear explicit hurdles on cash conversions. So margin durability and payback, not simple strategic enthusiasm. And what I'm saying here, actually, if you say, I'm going to borrow or going to do a round of funding for these, then you have to have a clear plan how this is going to pay back. And this is not a mathematical formula scenario or models. Now they are getting more sophisticated in terms of saying, I understand the model, now show me how you're going to do it. And if you didn't came across that question before in a very different shapes or forms, pay attention what they're asking. They are not asking for more models. They know the models. They understand the models. They are asking and say, show me how you're going to pay back, or how is going to be my return of this investment. And you have to be very clear how you answer that. But it's not with the better product line, the market, total addressable, the TAM, the SAM, and the DAM. No, it's not about that. It's about how exactly you're planning to give the money back, the return of the investment, or the interest, or the capital, right? So suggestion number three, treat portfolio stewardship as an operating discipline. So stop asking which initiatives sound important and start asking which assets deserve more capital. Assets. So which deserve less and which should be exited or discontinued before they keep absorbing management attention. And here's a magnificent example that I love this example, because when you say, well, yeah, but look at what Steve Jobs did in 1997 when he was asked back to Apple. He canceled 70% of the product line. That was about 210 products in a software and hardware company. So don't repeat what he did in his company. That's not the case. The case is, watch what is your company about and say, what are we doing that actually it creates recurrent revenue, repeatable revenue, or is volatile. And one of the reasons why he did that is because he understood one thing, and he explained that a few years later, I think. He was competing one by one with other companies about the same product, the same features, the same consumable for the customer. When he canceled 70% of the product line, what he focused, it was in the future, what was coming next to the consumers, not the things that they were consuming today, because you reach a point of saturation. So they have too many things about the same thing with a different brand, color, and shape. But in terms of the functionality, they start to be the same. They happen with services, it happens with products. So when you start to focus and concentrate your revenues in the things that actually are predictable, are recurrent, then you have the capacity now to thinking what is the next thing that will going to happen, and you can test it, right? Anyway, so this is where most boards get uncomfortable. And when I say board, it's management team, executive teams, etc., etc., because predictability sounds financial, but it's not financial. It's not. It's strategic. It's commercial. It's operational. It's a cultural thing in your organization. So you are where you are today because at one point you did that shift in the market in your organization that actually the market start to believe in you and buy from you, right? And when I'm saying you is your organization. So a business become predictable when the board, the executive team, and the founders refuse to confuse motion with quality, right? And we are looking always for what is the next things in terms of quality, not just how you move the organization. That means fewer pet projects, fewer unfunded ambitions, and fewer stories that about a future upside with no discipline underneath. And the future upside is a very, very nice talk, but when you go into cold numbers today, that future seems to be blurring very quickly. Now, what do you gain working with me? So it's three things: outcomes, differentiators, and risk reduction. In terms of outcomes, we use the advisory board operating system, this model that you have in front of you, to show where cash reliability is breaking down, then rebuild predictability through stronger revenue quality, tighter capital allocations, and clearer portfolio choices. In terms of differentiator, I work with the board to assemble, and the board, I mean your executive team, you as a founder, and your non-executive directors, to assemble an international advisory board around the actual constraint. For example, pricing or capital allocation, channel design. Channel design, I mean distribution that we talked yesterday. Who are your resellers? Which is your partner ecosystem? Who are your distributors, etc., etc., merger and acquisitions, or integration, or who is a CFO grade operating rhythm without the drag of a large consulting team and without locking the organization in one expensive executive hire that is too early for your organization today. And when I say international advisory board, because look what's going on in the world today. What I don't know what you plan in Q4 this year for this 2026, but how much change in the last 3 weeks. So I don't know what were your plans or what you planned in strategically for this year, but I can assure you, and without reading a single word in your plan, that things have changed in the past 3 weeks. And I don't need to go further there. And in terms reduction, I love this example. It's Sage. And if you haven't heard, Sage is a public company. And in 2025 annual report, they shows that quality looks like in public, right? So they say that their underlying annual recurring revenue rose 11% to 2.5 billion, and 97% of revenue was recurrent. Yeah. So that is not luck. That is not something like, oh, well, you're a software company, so that's your model. Listen, look at what the people are doing. Look what other big companies are doing. That is not luck. That is discipline design. So they designed this model to work that way, right? So here's something else. You know why people say, "Oh, they are so lucky. They are so." This have nothing to do with that. And I'm going to go that in 2 seconds, in a millisecond coaching session, if you may. That is because your board, your executive team, your management are two tunnels looking at what's going on today. It's linear. It's not an ecosystem like you have in your screen today, where everything is saw at the same time in every day at every time, right? So when you have a visibility that what's going on in your organization, then you can see where you have your constraints and where you have to balance the whole ecosystem so you can do the things that you want to do in terms of expansion, growth, international footprint, etc., etc. But because you're too busy on what's going on right now, right here, and I guess that this is happening today, we have month end in 2 weeks and quarter end in 2 weeks, right? The end of March. So we have two financial milestones for 2026 right around the corner. So and then you have all this geopolitical situation in the world that is impacting mostly everybody in a way or how today, or is creating concerns how we're going to address this, right? What are the scenarios? That's what I stress in international advisory boards, because you don't want an advisory board that is group thinking the same that you are thinking for the past 2 3 years or 6 months. You want people that are in different geographies, with different backgrounds, with different cognitive diversity, meaning they think and they experience and they live different things, but they are business savvy. This is what we're looking for. People that say, how are we going to do things differently? So, like Steve Jobs. So, like it's like apparently a very difficult decision actually was a right decision. So, predictability is not about becoming cautious. I'm not saying being careless. Caution, over caution, is about becoming governable, right? So look at the Formula One drivers, very dangerous guys in terms of what they have to do. 300 miles per hour, 200 something miles per hour, 300 kilometers per hour in a circuit, right? But they have a massive governance and security measurements there. They are cautious, right? But they are governing the danger, right? Once the board can see which revenue behaves like an asset and which behaves like a scramble, then decisions improve fast, right? Because you're governing an asset. You don't need to be cautious with an asset or overcautious. Obviously, you have the risk and compliance requirements, obviously. But the point is that when you are overcautious, so the capital goes to the right places, the forecast gets cleaner, the pressure drops, and growth stops feeling like an argument with the future. Like I say, oh, what's going to do now? We don't know. So what the future thinks, and that is gone because now you have an asset to govern towards something that is very specific. Now, one action you can take home today, and is doable in 30 minutes or less: list your top 10 revenue lines and mark each one as recurring, repeatable, or volatile. And then probably you start to have a better idea where you are standing in your organization in terms of the predictability of your organization. So let's pause here for today and reconvene tomorrow, because tomorrow I will show you why predictability still fails when the control theater replaces real operation discipline, right? And disciplines are all your systems. And when your systems is not necessarily software, is your standard operation procedures, your workflows, your triage. Triage is the ways that you handle things when they are getting messy, or how you handle things when they are getting good. Because sometimes, actually, I don't know if you heard that term, but actually you can be a victim of your own success. So how you handle that too. So if you're a founder, a leadership team, or investor that you need execution in a group and you want to help to restore your predictability, set up a 30-minute call so I can understand your position and how an independent international advisory board looking from outside in your organization can help you and your teams without stepping on your toes, without the traditional consulting overhead, and without the public theater. Have a great day, and I'll see you tomorrow. Thank you. And